Happy 2025. Welcome to Protect Your Assets. I am David Hollander. I'll be your host today and your drill sergeant this entire month as we roll out our New Year's resolution boot camp. First, our positive thoughts are with all our friends in the Los Angeles area that have been affected by the fires. Spoken to many friends and very, very sorry, of course, for everything going on there. And just know that our positive thoughts are with you and we will get through this. Thank you again to all the firefighters fighting the good fight and doing what they can. We so appreciate you. Well, it's so great to be with you on this clear, sunny day. Do we have an amazing show for you today? Yes, we do. For those of you just joining us for the first time, welcome. People around here, they call me the Sandman, and that's because I help you keep more of what you work so hard for so you can sleep well at night, not worry about that stuff. That's because I've been running a tax, legal, and financial firm for over 30 years. We are live in the studio right now. So if you have a question, maybe something came up this past week. We had a lot of good ones this past week. I'll be going through it today. Something comes up during the week and you just need help, shoot me an email. Love those. Email me to questions@pyaradio.com. Questions at PYA Radio. PYA stands for Protect Your Assets. So if you want to check out our podcast, go to wherever you get a podcast and just type in Protect Your Assets, and you will find our show there. We are living in such an interesting time right now. So many things are happening that are frankly out of our control. Since we started this show over 16 years ago, can't believe that, we've designated the month of January each year to do our boot camp series. These shows are designed to help you keep your New Year's resolutions. If you missed last week's show, it was the first one, the kickoff. It was our Financial Savings Class 101. We talked about the basics of saving when it comes to putting away more money in 2025. What are some things you could do? This week, this is our advanced class where we're going to unveil some of our top ideas for 2025 to supercharge your savings and generate more income now, more income in the future, pay less taxes later, all these great things you can take advantage of. If you're thinking about retiring this year, then this show is for you. Because we know that tax laws are about to change at the end of this year. So it's really important to focus on how you can pay taxes on your retirement for the next 20 years by setting up those dominoes right now. Or maybe you're like David. I talked to David this past week, and he had a great question. How should he transfer some of his assets right now while these rates are set for, again, just the remainder of this year, and keep more of that hard-earned money, those positions, that stock portfolio, the real estate, all that stuff he wants to pass to his son, but he wants to do it in the most effective way and pay the government as least as possible. So let me ask you a question. Are you prepared? Well, it seems that any time changes are coming, and we know they are. We'll see what the Congress can do. We just don't know. But we do know what things are right now, and that's what's important. And so as things change, it seems like people just go into a frenzy trying to figure out how they can navigate through all the rules and not get hurt. But the tax law is in flux, and we'll see what happens. So what should you do right now? Well, if you stay tuned for the entire show today, I'm going to help you decode and decipher the new tax laws and ways to generate more income now and in the future. If you plan on paying any taxes in the future, you're going to want to know all about this. Because if you're at or near retirement, then this episode, this Boot Camp 202 show, if you will, the advanced series, is one you don't want to miss out on. So it's a brand new year. Get something to write with and get your notepad open because I'm sure there'll be some ideas for you. This is going to be a great show, so keep it right here. Now, let's get started. Well, 2025 kicks off with some solid fundamentals, even as political shifts are underway. The Dow was down a little bit, off 1.9%, S&P off 1.9%. The NASDAQ down 2.3%, the 10-year Treasury Yields closed at 4.76, so up a little bit. Oil had a nice little run this past week, $76.67 a barrel, up 3.7% for the week. Year to date, oil's up almost 7%. Bonds off about almost 1%. So that begged the question this week, what does Wall Street expect for 2025? Well, first, how many times in history have there been 3 consecutive years of 10% or better returns for the S&P 500? If we go all the way back to 1928, you know the answer? 5. That's right, 5. 5 times. When was the last one? This kind of surprised me. I didn't remember this, but 2019 to 2021. Think about that. We had the pandemic. You feel like 20 was bad, but no, it actually ended up being a positive year. So 2019 to 2021 was one of the 5. 2012 to 2014 was the second. I remember this one, 1995 to 1999. That was a great time. I had just started getting into this business, started back in 93, and 95, 99 was a good run. 1949 to 1952. Don't remember that because I just wasn't here. And 1942 to 1945. That makes a lot of sense coming out of World War II. There you go. That's it. All the way back to 1928. Now, let me push it a little further because this is what's amazing. So if we're talking about 3 straight years in a row of greater than 20% positive returns for the S&P 500, how many times do you think that was? Close. I just heard 2. 1. 1 is the answer. 95 through 99. That was the one. So the point being is 3 straight years of positive returns in the S&P 500. It's pretty hard to come by. But as you can probably guess, that hasn't dissuaded anybody on Wall Street, the strategists in particular, from predicting that this year is going to be another good one. In fact, Wall Street is leaning towards the S&P 500 completing a double-digit performance three-peat using the index close on December 31st. You should probably write this down. 5881. 22 of the 25 firms that I looked at, that's 88% of them, by the way, they're predicting 10% plus returns in 2025. Now, I have the whole list from Oppenheimer all the way down to Stifel, BCA, LPL, all those. Got all the numbers here for you if you want to take a look at it. How accurate have these forecasts been lately? Well, not so accurate. In fact, strategists have overestimated stock performance in 13 of the last 20 years. So 2025 should be what then? Well, if we look at the economic fundamentals heading into 25, some things look pretty good. Even after this past week, we saw the GDP, gross domestic product growth, being positive. Inflation is still contained, and the Fed are still talking about moving interest rates lower. Those are all good things. This past week, remember, last week we talked about the highlights of what you wanted to pay attention to in January, so we've already been through one of those. I got a couple more to go. But this past week, the data confirmed that there was a continuation of this positive trend. And the labor number, remember we talked about that for Friday, still to the upside. And most importantly, wage gains, people getting paid more, that is outpacing inflation right now. And that's good. Consumers like that. Sentiment's positive. So those are all good things. And when you look at history overall, it shows that political headlines alone don't drive markets over the long term. Instead, financial markets, they look at the fundamentals, the things that we're talking about right now and what the Fed's doing. So in our view, the economic and labor market fundamentals are holding up, and the outlook for the Fed still positive, move rates lower. And I believe volatility will continue as it did this past week when we see rates pop up a little bit like the 10-year did to 476, right? That's higher, a little higher. Could go to 5. I think it's going to turn around and start going the other direction at some point. We don't know when that is, but it will happen. And when these volatility spikes happen, in other words, when bonds get more attractive than stocks, people start to shift out of stocks, and that drives the market down. And so you're going to see these pullbacks. But as long as the economy is looking good, and we're seeing the numbers we're seeing now, and things are still shaping up to be positive, when those opportunities present themselves, when these stocks go down in value, use that as your opportunity to rebalance, diversify your portfolio, and add the quality investments at better prices across the growth and value spectrum that makes sense. And this past week, we met a lot of nice people who had made some money the last couple of years, but so did everybody else. And they just want to know, what should we do now with this whole makeup changing in the government, with the Republicans coming in, with interest rates possibly coming down? Where should we be investing? Great questions. If you don't know what to do, well, give us a call. Keep it tuned right here, because when I come back, think you need to take that required minimum distribution? Maybe you don't have to. Find out how to do that, and find out how to get more savings now with the top rates out there. We're going to talk about that when we come back. So much more to come. We'll be right back. Welcome back. I am David Hollander, also known as the Sandman around here. So this entire month, we are doing our boot camp. And that's each week here in January to help you keep your New Year's resolutions. Maybe you were hoping to save some more money this year, maybe take a trip or retire or do something special. Well, let's face it, if you can save more, it makes it that much easier, that much faster. And this week, our second week in the series, this is our advanced class. We call it the Boot Camp 202. And how do we do that? Well, tax laws are changing, and we're hoping that Congress can get something together. But if you looked at a couple of the most recent situations, it's not that easy all the time. And so we'll see what happens. But right now, we know what it is, and you've got a few more months to do it. So if you want to take advantage of some of the things that are out there when it comes to IRAs, Roths, pensions, 529 accounts, estate planning, tax laws, all these things, well, I suggest you get on it now. So are you prepared? Do you know exactly what to do when it comes to these things? Well, we're going to get into that this morning. But if you need help, if you don't get everything you need this morning, and there is a lot to talk about, so I'll do my best to get through most of it. But if you find you're missing some of the nuances, maybe your situation might be a little different, there's a couple ways to access us to make it happen. First is come to one of our events. We're doing some dinner workshops wherever you're hearing this right now. What you want to do is you want to go to our website, libertygroupllc.com, libertygroupllc.com. Click on the events tab, and when you click on that, you'll see events all over the place. And you can click and register for that right now until they fill up. These have been filling up. We did one last Thursday night, and it was full. I did not have an empty seat in the room. It was crazy. But it's fun. I'm glad you're coming out and getting the information. So that's one way to do it. Again, libertygroupllc.com, events tab, register right there. Now, let's get into some material. Let's start out with some current ways to get more income right now. So I am looking right now at my computer screen, and this is an income strategy that will allow you, if let's say you're 66 right now, so you just had a birthday maybe last November or September or sometime back then, you're now 66. This one that we would set up for you right now, 6.99% immediately. And that will be fixed and guaranteed by the claims paying ability of this particular company I'm looking at right now. And that will last for your entire life. You heard me right. For as long as you live, it's going to pay you that amount. Now, let's say that your birthday is in April. And let's say you were to purchase this now in January. The 6.99% would then become 7.09% just because you had a birthday in April. And let's say you started your withdrawals in May, right after your birthday. Well, that's 7.09%. That's how it works. So for every birthday that comes by you get a bump. And that bump just continues to pay more and more income as you get older. So these are really good rates right now. And I would suggest you take a look at this. So for instance, if you could wait another birthday, that could be over 8%. Again, for the rest of your life. Think about that. I like this option right now, particularly if you're working, because it gives you a nice withdrawal rate that you can fix and lock in now. So no matter what happens to rates in the future, you're still going to get this nice high rate. It's protected from the market and the fluctuations that could go on there. And if you're making income right now and paying taxes, all this interest that you're going to earn on this product at the moment will be tax deferred. So you won't pay any taxes on this until you decide when to turn on that spigot. That's another thing I want to talk to you about this morning is taking control of when you decide to turn on the spigot, not the other way around, not when you have to do things. So that leads me to the next one, RMD. Required minimum distribution. It's called required for a reason because you don't have any choice about it. You must take it. And you must take these RMDs right now from your IRA in the year you turn 73. Now, you may say, well, that's obvious, duh. Well, I just met with the CEO of a pretty large company this past week who didn't know this. He knew it. He's a smart guy, but he wasn't paying attention. And he got hit by this for a couple of years. Now, he's going to retire later this year, but the last couple of years, because he got bad advice, he's been paying taxes on this, and he didn't know why. So this is important. Because if you say roll part of your 401k over to an IRA while you're still working and you're 73 or older, you're going to have to take an RMD off that and pay taxes on that, ordinary income taxes on top of your W-2 income. And that might be the highest tax rate possible. So you could be looking at 50% in taxes just on something you didn't need to do. So why do that? These are the questions. Now, what if you passed away and you didn't designate a beneficiary on your IRA account? Well, then instead of that 10-year distribution that's required right now, maybe you don't know what I'm talking about. If you have a spouse who inherits your IRA, there is no 10-year requirement. But if your kids are next in line, and let's say you and your spouse are wiped out in a car accident, well, then your kids have to take all that money out over that 10-year period of time. It all has to come out and all the taxes must be paid. But if for any reason the designated beneficiary on those IRA accounts is not there, in other words, there's a ghost, we call that a ghost because no one's there. You didn't either think about the next level or it just wasn't defined or what have you. These happen all the time. Or maybe you named your ex-spouse. It's another issue. Then guess what? It's 5 years. All that money has to come out in 5 years. So that could be a big problem because now all of a sudden you might have to start taking big chunks of money out each and every year and pay ordinary income taxes on that. Now I know what you're thinking. How can I keep all this in straight while I'm working? Because tax planning, it's not simple. And if you think about it, if you're going to pay 30 to 50% in taxes on those dollars that you're earning while you're earning them, what is your real return? So I don't really care if you're earning 4, 4.5, or 5% on a CD or a bond or a dividend paying stock. If after taxes you're ending up more like 3.5, well, what are some better ways to turn that back into 4, 5, 6, 7, 8% after tax return? That's what we're talking about today. You could be great at making money, but if you're not good at tax planning, you just gave up a third to half of every dollar you made. Think about that. It's crazy. So tax planning, it's not simple. It's confusing. And the deeper you scratch the surface, you know it just continues to get deeper. And that's why it makes a lot of sense to talk to a Liberty team member, because here in our office, we have CPAs. We have estate and tax attorneys on our staff. We also have certified financial planners and planners who work as a team. We work as a group, and we walk you through these decisions. Like yesterday, we were talking to a nice married couple, and they had 5 properties. And the first thing he said to me was, can you help us figure out which of our properties we should sell? And I said, why? And he said, I've been thinking a lot about what's going on in LA and the Palisades and the fires. And he said, my insurance has gone up crazy. And I know now with these claims that are going to come in, it's going to go up even more if I can even get insurance. And the properties are worth some pretty good money right now. And my after-tax return's like 1%. You know what that means, right? The return on your equity. How much equity do you have in that property? And what's your return on that? We can help you figure that out, by the way. But he knew it, and he said it's like 1%. So he said, even though I have a big capital gain, maybe I could just take it out and put it in a CD or something else. I said, you don't want to do a CD. You make too much money. Anyway, that's a whole other discussion. But anyway, you get the point. He wants to make more like 4, 5, 6% without the headaches of the toilets, tenants, and the trash. Do what he did, or what they did, sorry. Pick up the phone right now and find out what you can do about this. It's really simple. We do all the lifting for you. Just call us, 866-PROTECT, 866-776-8328 to find out at no cost how to do this. We'll walk you through it. And then we'll let you know what it costs. And if you want to do it, it's up to you. It's that simple. What do you have to lose? 866-PROTECT. Now, coming up next on Protect Your Assets, it's time for our popular They Say segment, where they say Roths always make sense. You're going to love this one. She was at our workshop Thursday night. I'm going to share her story with you. So much more to come. Keep it right here. We'll be right back. Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets this morning. And I just got one question for you. Was one of your New Year's resolutions to make some big changes to your financial life in a positive way in 2025? Well, if you answer yes, well, then you're going to want to listen to the entire show today, as I've pulled together our top ideas for 2025 to help you get on the right financial track as you ring in this new year. So if you missed last week, we did Basic Financial Training 101. And if you missed that, you can go listen to our podcast wherever you get your podcasts. Just type in Protect Your Assets, and you'll find our podcast there. There's a market segment, and there's also just the show. And so if you have a question about a particular topic, like we had a lot of people this past week. This past week, I had a question about Prop 19, and there is a show that covered Prop 19. In fact, we had one of the folks from the Howard Jarvis team on our show back in October, I believe, where we were talking about the ballot and trying to get that repealed, which was unsuccessful. But again, you can just search on your podcast for these topics, and most likely there's a show, because we've been doing this for over 16 years now. So there's a lot of content there. Think about it. Every week we got to come up with something new. So this week you've jumped into the advanced class. Whether you like it or not, you are in the front row of some information that's going to come at you that is hyper-focused right now on 2025 and keeping more of your hard-earned income and generating more dollars in your pocket by taking advantage of taxes. That's what today's all about. Now it's time for one of our fan favorite parts of the show, our They Say segment, where we debunk common myths, half-truths, and sometimes bad advice they say. All right, so here's one they say. In fact, I heard it this week. They say you always win when you do a Roth conversion. Is that true? Well, the answer is no. In fact, we were doing a workshop this past week, and we'll call her Helen. Helen was in the back. She was she was in her 40s, and she raised her hand and said, I did a Roth and it didn't work out. I got penalized. And I said, whoa, can you tell us more about that story? And she said, sure. She said that I had contributed, meaning she, had contributed to her Roth IRA last year. And turns out when she filed her tax return, she had to pay a tax penalty and unwind it. And so she said, I don't know if they're always such a great idea. And I said, well, that's a great question. Thanks for asking. And let's get into that. Because there are two types of Roths. Let's start with that. There's two types of Roths. You've got your contributory Roth and you've got your conversion Roth. They're different, totally different. In her case, she had done a contributory Roth. In other words, she was under 50. She made over $200,000 a year, and she dropped $7,000 into her Roth bucket as a contributory contribution. And she got penalized for it, and she had to undo it. So let's rewind. If you are sitting here in 2025 and you're wanting to do Roth because you can, if you can, that's the first question, if you can. So if you are single filer and you make less than $150,000 and you're under 50, then you can most likely do $7,000 into a Roth IRA. If you're over 50, then you can do $8,000 into a Roth IRA. Now, if you're joint filers, Kevin, and you make less than $236,000 and you're under 50, you can put away $7,000 into a contributory Roth IRA. If you're over 50 like me, then you can do $8,000. All right? Now, as you start to make more than those numbers, there's these percentages and ratios and all that. I'm not going to get into it today, but you can talk to your tax person about it and they'll help you. And so that's what she was talking about. She had done that incorrectly. She didn't have any help and she did it wrong and she got in trouble. She got penalized and had to unwind it. Not fun. So does a Roth make sense for you? That's the question. And I'm going to say maybe, because there's another type of Roth called a Roth conversion. And a Roth conversion, as we were talking about at the top of the show, and my teaser about RMDs, Roth do not have RMDs, do not require minimum distribution. Roth accounts do not. So that's why a conversion may make some sense later if you don't need your RMD. I know I just said a lot and your mind's spinning right now, right? So let's stop. Let's make this simple. Should you do or even think about a conversion Roth IRA? And what we're talking about is if you have a 401k or an IRA or a KEO or a SEP or something where you've been sticking money away all these years because it made sense. I remember in 93 when the 401ks came out. Remember that? I was around. I remember that. We were all over it. I was working for a big wirehouse, and that's what they trained us on. Go out and talk to people about the 401k. Here's why. Stick as much as you can away. Tax deferred, Well, who came up with that? The government. Because now that you're looking at it and you're going to have to start taking money out of it and you got your Social Security on top of it and maybe you got a pension and maybe you bought some real estate so you got rents and you start adding all this up, you could be making more in retirement than you did while you were working. It's a fact. You may not need the RMD. You may not want the RMD. You may hate the RMD, but you have to take it. All right, we're back. Let's go. So, when should you do a conversion? If you believe your tax bracket will be higher in the future, like in retirement, check that box. If you want to maximize your estate to your heirs, meaning you want to give them as much as possible and keep IRS Sam out of it, check the box. If your accounts aren't, this is a big one, diversified by tax treatment. Now, this is complicated, and I suggest you get our tool to figure this one out, because unless you're a CPA or a tax person and a financial person, you can look at these things on a spreadsheet, real time, you're missing out. So if that's you and you want to do something like this, check the box. How about this one? You have irregular income streams and lower than usual income this year. Now, maybe you own your business and maybe you had a good year last year. And so you took a bunch of money and you stuck it in your business to grow. So this year is not going to necessarily be a good year for you. You know that already. It may change and you could switch, but let's just say you're going to have not such a great year this year. Check the box. This might be the time for you to convert some of those dollars now, pay less taxes on them because we know what the tax rates are this year, and then let that grow tax-free for a long time and then take it out later tax-free. This is what I'm talking about. Now, who should not consider doing a conversion Roth IRA? Let's say you're nearing retirement or you're in retirement and you don't have long to go. You know what I mean? Don't do it. Let's say you need your traditional IRA or your 401k to cover your living expenses. So you're going to live off of those distributions. Don't do it. Let's say you're currently receiving Social Security or Medicare benefits. You may want to think about this because this will change your tax brackets. Because as you pull more money into income, you get less Social Security, you get less Medicare benefits. They tax you more on that. So you got to look at those things before you do it. You don't have money to pay the tax on the conversion. So when you pull money out of that 401k, that IRA, you're going to have to pay the tax for that year's income. And we recommend that you take it from your savings account or from other assets, that you don't diminish the value of that conversion. So if you're not in that bucket, then maybe you don't do this or all of it. How about this one? You plan on giving a substantial amount of your IRA to charity. I have a whole show on this, QCDs. Go listen to that show. That's complicated, but it's a great strategy. And it's a way, again, where maybe you don't need to do a Roth conversion. And note this, please put a big asterisk by this. If you do a conversion, you can't unwind it anymore. Once it's done, meaning penalties, taxes, interest, all that kind of stuff. That was a lot. I know. Take a deep breath, relax, call me right now. We'll help you do a tax analysis to see if this makes sense, because it's complicated and you should get in front of it before you do it. Doesn't that make sense? Talk to people who do this every day because it can help you. 866-PROTECT. That's the phone number. 866-PROTECT. We have great coffee, free parking. Dylan's back there right now with a nice smile on his face. He's a nice young man. Call him. 866-PROTECT. John D. Rockefeller said this. So he was one of the wealthiest men ever to live. The surest way to accumulate wealth is to not pay tax on income you don't use. You hear that? How did he do it? Well, we're going to teach you a tax hole loop coming up next. I'll share it with you. Your list to protect your assets. We'll be right back. Welcome back. I'm David Hollander, also known as the Sandman. And you are listening this morning to Protect Your Assets. And I got a question for you. Is one of your New Year's resolutions to make some big changes to your financial life in a positive way in 2025? Well, if you answer yes, then this entire morning we've been talking about this. And the month of January is dedicated to our financial boot camp to help you get in shape when it comes to this sort of thing. Because if you've ever been to Barry's, you know what I'm talking about. It's intense, it's focused, it's short, but it gets results. And so today we are talking about taxes. And the best way to do that is to plan smart, get in front of it, and be proactive. Think about it this way. When was the last time your financial advisor asked to see a copy of your tax return? You're listening to today's show so you can understand how tax reform is going to impact you. So you can take advantage of the 500 plus pages of that tax code. And if your advisor doesn't know your tax situation intimately as they're helping you make more money, well, guess what? They're not helping you because you're not using taxes efficiently or to your advantage. Think about it like slapping a turbocharger on your car. You get that much more power, and it's just right there. And that's what taxes are all about. 30 to 50% of every dollar you make, you're going to give away in taxes if you don't do it efficiently. So real quick, did you see the Forbes article where they were talking about California? Well, now the capital gain rate in California is up to 14.4%. You heard me right, 14.4%. You add to that the NIT tax from Obamacare, it's 3.8%. And if you have a top capital gain rate of 20% federal, you're looking at 37.1% just for capital gains. So that's one thing you need to worry about. If you're going to do a big transaction this year, get in front of that before you do it. Before the break, I was talking about a tax loophole. And here in 2025, we have a good one, particularly if you have an estate problem or you have an IRA with RMDs that you don't really necessarily need. Pay attention to this one. There is a 529 loophole. And what I mean by that is in 2025, you can put away $95,000 per beneficiary right now. What do I mean? Let's say that you have a $1 or $2 million estate tax problem. You could start to give away $95,000 tomorrow to 5 or 6 or 7 family members in a structured way, of course, whereby all that money goes into a tax-free growth strategy for your family for education. Now, I'm a huge proponent of education. Education changed my life. Thank you, UC Berkeley. Yes, I paid my way through school and I worked jobs and all that, but that's good. Nothing wrong with that. And so if you believe in education, you want to educate your family with some of your wealth, you don't want to necessarily set up an expensive foundation, well, you can do it with what I'm talking about right now. And if you put away that kind of money and you let it grow over time, hopefully 10, 15, 20, 30 years from now, they'll be there to educate your family. If you need help with this, a couple ways to get some help. It starts with our Tax Smart retirement projection. Call us, 866-PROTECT, to get your personal projection created for you for 2025 at no charge, 866-PROTECT. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. My executive producer, network manager, Kevin Renfer, and of course, Raph Dillon back there doing all the work. Because without my team, I'm just another pretty voice on the radio. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.